Let us start with the understanding of the basics of the stock market. So, we're going to learn about the history of the stock market, followed by different types of the market, key financial instruments that are traded in the stock market, and then go a little deeper with understanding two of these key financial instruments, being shares and derivatives, and finally move on to the hierarchy in the stock market. So in the 1800s, people were not trading using electronic mode of trading. Trading was mainly done at Dalal Street physically by hand movements. But as we progressed, this this type of trading actually was then converted into a stock exchange by the Stock Brokers Association, and the first um, stock exchange was the Bombay Stock Exchange, which was actually recognized in 1956 under the Securities Contract Act. Followed by 1993, we had the National Stock Exchange. So we had the Bombay Stock Exchange much before the National Stock Exchange actually was formed. Till date, we still have both NSE and BSE where shares are listed. It's not the same shares which are listed on both. Some are different. Now, main revolution came in 2000 when we completely moved on to internet-based trading. That is in 2000, we were allowed to trade through the internet instead of actually physically going to a broker's office and having a terminal to trade. Then we have commencement of derivatives trading, which is when futures and all of this options trading was started in the year 2000. Since then, it has continued and picked up a lot of momentum. Now, let us understand what are we actually trading in the stock market. So, a company which would like to raise capital for their business will decide to go and offer their shares to the public via the stock market. So initially they come up with an IPO or the initial public offering, which is released in the primary market. So primary market is nothing but it's only an IPO. It basically means any company which has never offered itself to trading or has not offered its shares to the public. When they do it for the first time, it is it is called a primary market, the IPO offering, and from there it moves on to the secondary market, which is our regular trading, which is monitored by the stock exchange. So this is how it moves. It starts with an IPO. A company decides to raise capital for themselves. They offer an IPO. It's an entire process. People subscribe to the IPO, and after the IPO has gone live, this company shares are available to trade on the stock market, which is known as the secondary market. Now, you have to understand one thing, that it's not that every single company has to be present in the stock market. It depends on what the company founders and the promoters want, whether they really want to be offering their shares to the public or not. For example, Amul is a huge company, it's a very big group, but they are not present on the stock market because they do not want to offer their shares, they do not want to raise capital, or they have other ways of doing that. So it is entirely up to the company whether they want to get listed on the stock market, offer an IPO or not. There are four main financial instruments that are traded in the stock market, namely bonds, shares of companies, derivatives of derivatives are, as the word says, they are derived from the shares. So these are derivatives, they are different instruments, but they are dependent on the actual shares itself. And then we have the mutual funds. So we are going to specifically understand a little more about the shares and the derivatives. When you're trading the shares of a company, that is in general referred to as the cash market or the equity segment. So equity segment of the cash market is nothing but um, when you are going to buy a particular company's shares. So it means you cannot be on the short side for more than a day. So you can either make money by buying and holding onto the stock, or you can stay out. But you cannot really make money by shorting the stock and holding on to the position for more than a day. So you're allowed to sell or short only for a day, not more than that. But when you talk about going long or basically buying the shares, you can buy and hold on for a long period of time, as long as you wish. Another important factor about the cash segment is that you have the liberty to choose the number of shares you would like to buy. Like you can buy one share and hold on to that one share for as long as you wish, or you can buy 20 shares, 100 shares, as much as you wish. There is no restriction on that, there is a minimum quantity that you need to buy. Right? So these are the main features about the cash segment. Let us understand the cash segment more from a real market perspective. These are the shares listed under Nifty 50, which means these are the top 50 companies of our country. I'm sure all these names are quite familiar to everyone. We are talking about Axis Bank, we're talking about Bajaj Finance. So if you look at any of these shares, what we're seeing is what is the value of each share right now. So if we talk about Bajaj Finance, one share costs 7,000 rupees currently, as of now. Whereas for Axis Bank, one share costs 800 rupees, which means if you want to buy a share of Axis Bank with 803.8 rupees, you can buy one share. So depending on your capital, depending on how much you want to buy, you have the liberty to buy these shares. This is actually referred to as the cash segment. Here you can buy at any price. Right now, price at 803. It is possible the price might come down to 750 or maybe go up to about 850, 860. So depending on what price you would like to buy, you can go ahead and you have the liberty to do that. How to analyze which is the right price to buy, that will be taught using technical analysis. So these are the shares. You can see we have SBI, which is currently at 529.6 rupees. We have Maruti. One share of Maruti right now costs about 8,737 rupees. We have ITC, which is at 232. So, depending on what makes sense to you or whatever reason you have the liberty to choose your and pick the shares that you like to buy, along with the quantity with no expiry date. You can hold on to them as long as you wish. Now, coming to derivatives. So derivatives, as the name suggests, have been derived from the cash segment or the cash or the stock itself. So as you have the stock of Axis Bank, you would also have a derivative of Axis Bank stock, which means there's another instrument which actually works on the uh, same way, in the same direction as the main instrument, also known as the underlying stock. So derivatives are two types of derivatives. We have options and we have futures. We're going to understand in a lot more detail about options and futures later in our month two. But at the moment, we just need to know that both under options and futures, we have different types that can be traded. So first of all, you have stock options, which are, let's say, options of Axis Bank, options of Bajaj Finance. These are different options. Then you have index options like Nifty and Bank Nifty, which are traded. We also have commodity options like gold, silver, crude oil. These are also offered as option instruments. And then we have currency options like USD INR, Euro INR, all of these different currency. So we basically have three: GBP INR, USD INR, and Euro INR right now, which are the main currency pairs. These are under options. Same way, we also have futures of these same, like we have index futures, we have stock futures, we have commodity futures, and we have currency futures. So all these can be traded either as a stock, as either as an option instrument or as a futures instrument. Now, if you're finding it a little confusing, it's okay. We are going to get a little more in detail about these things as we progress through the course. But it is important to understand that it is the cash segment or the shares right at the top, and everything is derived from the shares. So when we say everything is derived, it means that the price of options and the price of futures of any particular instrument is derived from the price of the stock of that particular instrument. Okay, when you're talking about stock futures, same way with commodity futures, same way with currency and indexes. So we'll keep this for later and move on to how this is done in terms of hierarchy of the stock market. So we as retail investors are right at the bottom. We would like to share take trades. So we go to our broker, and the broker helps us place orders through the National Stock Exchange or the Bombay Stock Exchange. Now, when you're placing an order, it simply means you want to buy certain shares from the market. There's a limited number of shares available in the market, and there has to be always a seller available for us to buy shares. So there should be somebody who's willing to sell his shares, and we can go ahead and buy these shares. Now, the role of the broker is to facilitate the exchange of shares between two parties. So, a retail investor or a trader would like to buy shares. They go to a broker, they open an account with them. The broker will ensure that if they have, say, 10,000 customers, or in general, if there are a lot of people trying to buy and sell, the broker is going to connect these people. How the broker does it is through the help of the exchange, either the National Stock Exchange or the Bombay Stock Exchange. So people throw orders, these orders go to the exchange, and through that, the trading is facilitated. Now, right at the top, we have the Securities Exchange Board of India, which is popularly known as SEBI. SEBI is a regulatory authority. It ensures that all uh, the market participants are being offered fair value. They are not being cheated in any way. So the brokers are doing their job properly. The exchange is doing its job properly. SEBI overlooks all of this and is mainly the market regulator. The role of SEBI is that they would like to increase the number of players in the stock market, and they look at developing the stock market. That's all for now. We will see you again. Thank you.